I'm so happy to be here with you today. Today, I'm going to do a short and sweet episode that is just a bit of tax basics. I'm actually writing a book right now about taxes, and I'm really in kind of education mode, thinking about what do people need to know that we're not being taught in school, in our adult lives. And I think the answer to that is everything. But that's, I say this all the time. If you've ever heard me give a workshop or a lecture, there is no tax education in this country. And I think most of us, especially when we're creative and we already kind of feel like, oh, I don't know business terminology, I never got trained in the business side of things. We feel like somehow not knowing about our taxes is our own failure. And I just want to reassure you that actually there is no tax education in this country. And the fact that you feel kind of stupid about it is literally the marketing strategy of the large tax companies. They are there to make you feel that way and to lobby Congress to not allow tax education to be part of a basic civics class that you might take as a requirement in high school, which I think is what we should do as a culture. All right, so what do you actually need to know? Let's do one of the building blocks today. So this is a very all-purpose episode. I'm going to talk about the schedules. What is a tax schedule? All right, I'll make it as fun as I possibly can. This is a very universal episode. Feel free to share it with literally anyone who has a tax return. It's not only going to apply to people with a Schedule C, though I do hope to clarify the real tax role of a Schedule C. The Schedule C is just the reason I'm pulling that one out is that basically that's my audience. That's you, the listener of Sunlight Tax. The Schedule C is where you put your self-employment income. And I'm generally trying to teach self-employed people because we're the ones whose taxes are harder and we have to do it all ourselves. And when you pair that with a lack of tax education to begin with, it's a recipe for a mess, right? So I'm just here to try to give you some encouragement. Like, you're not behind, you're not backwards. It's not you, you're not stupid. Let's just get you one of the big building blocks of your basic tax knowledge in place today. All right, cool. So I'm going to talk about today what the tax schedules are. Okay. You might have some vague awareness of that, that word, but we're going to really get into it. And again, if you want to share this episode with, your spouse, your partner who you file taxes with, or anybody else who wants a little, tax background, tax basics, this episode in particular is not just for self-employed people, because I'm going to talk about all of the schedules. So the big things we're going to cover today, because of what is in the schedules, are capital gains, self-employment tax, and itemized deductions. Okay. All right. So let's get started. So first of all, the whole reason, the basic structure of your tax return, just to set the groundwork, the basic structure of your tax return, it is called a 1040. Your personal income tax return is called a 1040. Okay. And the 1040 is just 2 pages, really. And then there's a whole bunch of addenda and extra things and schedules and special worksheets that kind of hook into the 1040. And basically, there are different schedules for good reason. The schedules exist to separate out different types of income for different types of treatment. In other words, under the US tax code, we don't tax all income equally. Some types of income are taxed in different ways, and some types of income have different tax rules applied to them. And for that reason, we put those types of income on their own separated out space, and those spaces are called the schedules. Okay, so for the record, the schedules I'm going to cover today are the letter schedules, Schedule A, B, C, D, E, and F. I'm going to talk about those today. You might notice, if you've really got a keen eye, you might notice there's also some other schedules on your tax return, like the Schedule 1, 2, and 3. Those schedules are kind of new in the tax code. Those only exist after the 2017 Tax Cuts and Jobs Act that was passed by the Trump administration and the Republican Congress that was voted in at that time. And those I kid you not, they said they were going to simplify the tax code and make it the size of the postcard. And what they did was literally shrink down the front page of the 1040 to the size of a postcard and then add 3 new schedules behind it. The thing is, most taxpayers don't look past the first page of their tax return. So for most people, that was enough hiding to make most people not notice it. But of course, every tax practitioner I know was rolling their eyes over that quote, simplification. Anyway, so schedules 1, 2, and 3, just to like give you the quick and dirty rundown of those. Those are not the focus of today's episode, but basically schedule 1 is for other additional income, right? So some of the schedules I'm going to be talking about today, schedule A, B, C, D, E, and F, some of those amounts, the summary number might get put onto the schedule 1. The schedule 2 is what I forget, it's adjustments to income. And then the schedule 3 is non-refundable credits and some other stuff. Okay. That's the schedules 1, 2, and 3. In other words, they're still sort of summary pages. They're still basically what I consider to be part of the basic 1040 tax form. So pretty much most taxpayers are going to have something on, certainly everyone will have something on your first 2 pages of the 1040 tax form. And then you may or may not have additional stuff on schedules 1, 2, and 3. Okay. All right. Now we're going to set aside schedules 1, 2, and 3. We're done talking about those. We're just going to talk about the letter schedules. Okay. Okay. So what are the schedules and why do they exist? They exist because different types of income needs to get separated out because it's not all treated or taxed in the same way. So let's start. We're going to go in alphabetical order today. Schedule A. The Schedule A is the place where you put itemized deductions. Now, there's a piece of clarification that you may have heard me do before. I actually have a whole episode of the Sunlight podcast that is about the difference between business deductions and itemized deductions, but I'm going to repeat it here because almost everybody needs to hear this a couple times to really clock it. And I just see people getting mixed up about this so frequently that I'm here to just repeat this over and over again. So itemized deductions go into Schedule A, and they have nothing to do with your business deductions, okay? Nothing whatsoever. So here's what itemizing is if you itemize. Basically, and consider this another piece, like another major building block in the foundation of your tax knowledge, understanding what itemizing is and whether you itemize or take the standard deduction. This is actually a very key piece of tax knowledge that you should know. It's a good idea to know which camp you are in and if you are approaching the other camp and about to cross over into it. Okay, so here it is, the summary. Every US taxpayer gets an initial chunk of their income tax-free, which is great. And you can either get a tax-free amount that is fixed, and we call the fixed amount of tax-free untaxed income the standard deduction, or you can get a variable tax-free amount. And that variable amount, alternatively, is called itemized deductions. So that's the either or. You either itemize or you take the standard deduction, okay? The mistake I see a lot of people make is they think they either itemize or get business deductions, and that is not true. That is not true, okay? So you either itemize or you get the standard deduction. The standard deduction amount is about $14,000 for a single taxpayer, and it's approximately double that for a married filing joint couple. And then head of household is a number in between those two. And head of household is basically somebody who is single but has dependents, okay, in the tax code. So that set amount of tax-free income, so let's say you're single and it's around $14,000, you get to earn up to $14,000 before any income tax touches you, okay, before a tax rate will actually start to affect tax that you pay on that income, okay? Now, alternatively, you could itemize. Now, itemizing is about certain key types of deductions that for various reasons over the years have been put into the tax code as itemizable deductions, okay? These have nothing to do with your business, but this is what the list of itemizable deductions are. And they basically all go in a bucket together. And if everything in your itemizable bucket outweighs the standard deduction, then you will itemize, okay? Because you get to pick which one you do, the logic is very simple. You take the bigger number, okay? You're always going to go for the higher amount of tax-free income, right? Of non-taxed income. So you're only going to itemize if you have itemizable deductions filling up the itemized bucket to be greater than the standard deduction amount. So to know if you itemize or not, you need to be checking what this year's standard deduction is for someone in your tax status. So single, head of household, married filing joint, married filing separately. And if you have itemizable deductions that exceed that, you're going to itemize. So here's what itemized deductions actually are. They are mortgage interest. So please note, the chances are good that if you're a renter, you don't itemize, okay? It is definitely meant to favor the homeowner, okay? That's first and foremost. So mortgage interest, state and local taxes capped at $10,000. That cap was a tax change that happened in 2017. There's some controversy around it, and we may one day see that cap come off again. There used to be no cap, but there is right now a $10,000 cap on your state and local taxes. So mortgage interest, state and local taxes capped at $10,000, charitable contributions, and medical expenses only once they exceed 7.5% of your adjusted gross income. Okay, that's all kind of a mouthful, but please note those 4 items, those are itemized deductions. And so if you have a combination of charitable contributions, state and local taxes up to $10,000, medical expenses only over 7.5% of your adjusted gross income, and or mortgage interest, and they exceed the standard deduction, then you will be one of those taxpayers who itemizes, okay? Most of you listening don't itemize. Most taxpayers in the US, 90%, take the standard deduction. So chances are good you don't itemize. And I just want to reassure you, you never heard me say anything about business deductions in itemizing. They're not related. Your business deductions, and we will get to this, go in a Schedule C, and the Schedule C isn't the Schedule A. They're 2 different things, okay? So your itemized deductions go in a Schedule A. So if you have charitable, mortgage interest, state and local taxes, medical expenses that are really, really high, those will go on a Schedule A. That's where they go, okay? So you're only going to have a Schedule A if you don't take the standard deduction, okay? All right, so that is what the Schedule A is. Schedule B is dividend and interest income. That one's pretty straightforward. And just a little rule for you to know is that your bank, you're only required to report interest income once it exceeds $10. So you may notice that even though you have 5 different bank accounts, you don't even get any statements reporting your taxable interest. And the reason for that is because you didn't make $10, over $10 of interest from that bank account if you didn't get a statement. The bank only has to send you a statement, and they probably only will if you made more than $10 of interest. Okay, so I know sometimes people get nervous about that. They think they're breaking the law, and actually, no, you just didn't cross the threshold to have reportable interest. Now, in the environment we're in currently, where interest rates are actually substantial, you know, we've had historically low rates and basically nobody got any interest from their bank accounts. This year, you might actually make some interest. So this might be a year where you start getting bank statements reporting your interest where you never did before. So don't worry about it. You get that statement, you're going to report it on your tax return. And it's going to go on the Schedule B, which is where we put dividend income and interest income. Okay, the Schedule C. The Schedule C is the one that I focus most of my attention on in the education and workshops that I do through Sunlight Tax. The Schedule C is for you. It's for self-employed people. So the Schedule C is where you put profit and losses from your business, okay? Now, the actual tax roll of a Schedule C is is to calculate how much taxable profit you have and therefore what income you made that is subject to self-employment tax. A lot of people don't realize that. If your income is reported on a Schedule C, it's not just subject to income tax. It is subject to income tax at your income tax rate. It's also subject to self-employment tax, which is totally fair because the way that self-employment tax works is self-employment tax is your payment as both an employee and an employer. Remember, when you're self-employed, you're both things at one time. It's your payment into your Medicare and Social Security. So you pay 15.3% of your profit, not your gross income, but your profit. So after you've taken out expenses, and you pay 15.3% of your profit towards your Medicare and Social Security. The point of that is that one day you have Social Security to draw on and you have Medicare to draw on when you're past your working years, okay? And employees, effectively pay into the Medicare and Social Security system too. Employees only pay half because they're only an employee. They're not also an employer, right? So their boss pays into the employer half, and we call that payroll tax. But the employee is having 7.65% of their pay taken out of every single paycheck, every single pay period, to cover their Medicare and Social Security contribution. And meanwhile, in the back offices of their employer, the employer is also paying into that employee's Medicare and Social Security at the same rate, 7.65%. Okay. When you add 7.65%, when you double it, it equals 15.3%. And that is the reason that self-employment tax is 15.3%, because it is 7.65 times 2. It is employee half plus employer half at the same time. Okay, so that's the whole reason that your income when you're self-employed goes on a Schedule C and is subject to self-employment tax. That's the reason it has its own schedule, because we're trying to see what amount of Medicare and Social Security payment you need to contribute. Okay, so that's effectively the role of the Schedule C, and also just some structural stuff. And please send me feedback about this episode if you want a deeper dive specifically on the Schedule C in a future episode. I'm very happy to do that. But essentially, the structure of the Schedule C is very simple. You list all your income from your self-employment. So that's gross income, that's before expenses. So all your client payments, all your Etsy sales, all your Stripe and Venmo, all the payments that you got, you're going to list them in summary form. There is a section for cost of goods sold, where the unit cost of each item that you sold, you get to put onto your tax return as well. Do a little calculation there. Then you put your expenses. So page 2 of the Schedule C is all of those business deductions. If you have not yet downloaded my guide to those business deductions, I have a free visual guide to them. And in fact, for 6 different fields. So I have them for performers, for visual artists, for online business owners, a general one for creators. I have one for makers. And one for designers. So if you're in any of those categories, feel free to go to sunlighttax.com/deductions guide, and you can definitely go download my free visual guide to those Schedule C deductions. I have all the rules laid out very, very clearly in this beautiful printable reference form. So you really don't have to stress about what those are. Just go download that guide, print it out by your put it near your computer or wherever you do your bookkeeping, and you kind of have that for life. Although you'll maybe want to come back every year for the update. I do update that every year in January. Okay, so again, last time I'll say this, that is at sunlighttax.com/deductions guide, and that guide is free. Okay, so that's the structure of the Schedule C. So you put your income, your gross income, the big number, then you're going to list out all the deductions that you have. And of course, you do the math. What is the big number minus the deductions equals your profit, okay? Profit is what you are taxed on. So that number is going to be your taxable number. It's also going to be the number that is subject to self-employment tax. Once we calculate your profit on the Schedule C, Only after that point does the home office kick in. You'll notice that the home office comes below all the other deductions on your Schedule C if you're actually looking at the physical Schedule C document. And the reason for that order, which might not make sense, is because a home office or a home studio is only deductible if you have profit. So we don't bother letting you put those numbers onto the return if you're going to come up with a negative number and have a loss. I want to remind you that the title of the Schedule C, the subtitle, is profit or loss. So a loss is allowed. You can have a negative number. In other words, you can have expenses that are higher than the income that you brought in and still be a legitimate business. I want you to understand that actually what makes you a business, according to the IRS, is your profit motive. So are you trying to make a profit? That intent to make a profit is the definition of a business versus a hobby. Hobbyists don't have an intent to make a profit, right? Hobbyists are doing it for fun, for satisfaction, for something to do in their spare time, right? A business is trying to make some money. That doesn't mean it has to be your sole focus in life. Doesn't mean you have to prioritize money above everything else. There's many years that businesses, even very, very wise and very, very profit motivated businesses will make a big investment year, right? Where they know that their profit is going to be little or maybe even negative, in other words, a loss, because they're making a big, big investment, whether in labor, staffing, a new piece of equipment, manufacturing equipment, a new space, et cetera, right? So even the most profit motivated business isn't always going to have a profit, which is why we know, because of the title of the Schedule C, that a loss is actually okay when it is, conservative and rare enough. You don't want to have a loss every year. That starts to feel a little fishy to the IRS because, who has a loss every year in their business without saying, gee, this isn't working out, I'm going to try something else. Okay. All right, so that's the Schedule C. Again, I can do a future episode that goes way deeper on the Schedule C. That's kind of my bread and butter, and I love it. But that's kind of the high level, broad strokes of your Schedule C. Okay, the next one is my other favorite, the Schedule D. Schedule D is capital gains. Now, when you study the capital gains rates in this country, you will quickly learn that it's good to be a capitalist. We don't call this a capitalist country for nothing. Capital is prioritized. It has more favorable rates under our tax code than earned income. Okay. So that is something very key to understand. We don't treat all income equally. When you do labor, when you do work, when you are paid by the hour, you are earning what is called earned income, and it is taxed at a rate called ordinary income tax rates. Capital gains have different rates. All right. So I want to give you a little, without doing too deep of a dive onto the Schedule D and capital gains, I want to give you sort of overview of what it means to have capital gains. First thing to understand about capital gains is when you are selling property that you have owned. Now, this property could be real estate. It could actually be like artwork or collectibles. But capital gains most often for most people is going to be equities. In other words, stocks and bonds. Okay. So if you have, and I really hope you do, this is a whole mission of mine, is for creative people like you to have fuck you money. Well, that fuck you money is capital gains. We want you to have it. We want you to have, be taking advantage of the good things in our tax code. And part of that is actually amassing some capital. This is where we're talking about, when we talk about generational wealth, it's capital. Okay. And I want you to have it. Okay. So the basics of the capital gains go like this. There is short-term and long-term. So let's say short-term capital gains are anything you hold, like you own the thing for less than a year. Okay. Now, it's very important to understand that short-term capital gains do not have the favorable rates, okay? Short-term capital gains held for less than 1 year are actually taxed at ordinary income tax rates. In other words, they're taxed just like earned income, okay? And that makes some sense because if you're buying and selling stuff within 1 year, that you're earning it. You're kind of doing that as your work and not as an investment, right? Investments are long-term. I cannot say this enough. Every time I teach about investing, I'm always like, not short-term, not short-term. This is a long-term thing, okay? So if you sell it within a year, your tax is much higher. It's taxed at the rate of earned income, ordinary income tax rates. Okay, so that's the first thing to know about your capital gains. Still, that will be reported on your Schedule D, but there's a box where you're going to actually have dates on your capital gains Schedule D, so that it's clear how long you held the item in question. Usually that's going to be stocks, but it could be a piece of real estate, a car, etc. Now, long-term capital gains is where it's at. Long-term capital gains are where we get into favorable tax rates. Capital gains rates are much more beneficial and they're lower than earned income. So I don't want to make the most boring podcast ever by reading a bunch of rates to you, but I'll read a few to give you a sense of it. And what I'll do to be helpful to you is I will put a link in the show notes here to a rate chart. So you can go look at where you might fall based on your level of income in terms of your long-term capital gains rate, because that's kind of the info that you want. This is the kind of thing that makes a good chart and makes a good reference guide, does not make a compelling podcast. So I'll try to keep it kind of short for you. But for the year, the tax year 2023, the capital gains rates, so for every year, unless these rates, some radical shift in capital gains happens, and you will hear about it in the news if that ever happens. But capital gains rates are, for long-term, are either 0%, 15%, or 20%. Okay. By contrast, ordinary income tax rates range from 0% to 37%. Okay. So 37% might look really high, but remember, that's only for salaries. That's only for income that you earn. Capital gains tops out at 20%. In other words, capital gains rates, even at the high end, are much, much lower than earned income. Okay. So here are, if for a single person, here are the 2023 thresholds for the 0%, 15%, and 20% rate. So if you're filing single, your capital gains rates for tax year 2023, so if you sell equities in a portfolio, for example, you're taxed at a 0% rate, so no tax, if your income is up to $44,625, okay? 0%, okay? That's quite a good deal. Tax-free capital gains. You're in the 15% rate as a single taxpayer between $44,626 and $492,000, $492,300. Okay, so you might want to kind of ballpark in your brain about $500,000, $500,000. Okay, it's actually a little lower than that, but as a ballpark, around $500,000, you bump up into the 20% rate. So between $44,000 and $490,000, you're in the 15% capital gains rate. And then over $492,300, you are taxed at the maximum long-term capital gains rate, 20%. Okay. These same numbers for a married filing joint couple are $89,000 up to $89,000 of married filing joint income. So that's you and your spouse together, will be taxed at a 0% rate. The 15% rate is between $89,000 and $553,850. So notice that it's not double the single rate. Married couples actually kind of pay a higher rate because you're being taxed. How do I say this succinctly? It's not just the married filing jointly capital gains rate is not just double the single rate. Okay. And if you're married filing jointly and you have a combined joint income over $553,850, you'll be taxed at the maximum 20% long-term capital gains rate. Okay, that's enough numbers. I will include a link to that rate sheet in the show notes so that you can go reference it. Again, like me reading numbers like that makes for not interesting podcast listening. Okay, so it's good to be a capitalist, even at the highest rate, even if you're in that 20% rate, and you're quite wealthy if you are paying the 20% rate. That's still lower than the 37% maximum for that you might pay on ordinary income, earned income. Okay. As a baseline, though, most taxpayers, middle-class taxpayers, you can think of the long-term capital gains rate for you as 15%. Most of you are going to be in the 15% category. Okay, moving through the rest of the schedules, I'm only going to talk about two more. We've got the Schedule E, which is for rent and royalty income. So rent and royalty, the Schedule E, is actually structured in a very similar way to the Schedule C. You'll see that it looks very similar. You list your income, you list your expenses, you calculate the difference, which equals your profit, okay? Most of you are going to use the Schedule E if you have some kind of rental property. That includes short-term rentals like an Airbnb, VRBO, etc. But I do want to make a note about royalty, because a lot of people in the creative fields, a lot of you who might be listening now, you might actually get royalties. So there is one little note I want to make about royalties. So royalties that go on a Schedule E are on purpose on the Schedule E, because the Schedule E is not subject. It has a very similar structure to the Schedule C, but it isn't subject to self-employment tax. That's kind of a big difference between those two schedules. However, if you get your royalties as a function of your self-employment, they don't belong on a Schedule E. They actually, in that case, belong on a Schedule C, because if it's a function of your self-employment income, it is also supposed to be subject to self-employment tax. Rightfully, that is the fair thing. So, for example, I have had a long-term tax client who does pattern design. So she makes these really beautiful, beautiful patterns, and they are licensed for textiles, for wallpaper, for bolts of fabric, things like that. And she is doing that professionally. So that royalty income will go on her Schedule C. Okay. I have another client who had a grandfather who wrote a very, very famous play that has been on Broadway for years and years and years. She didn't write it. She just inherited the royalty checks from this. Her royalty income goes on a Schedule E, because that is not a function of her self-employment. Okay. Do you see the difference between those two treatments? Okay. So Schedule E, rent and royalty income, but your royalty income, if it's part of your self-employment, is going to go on the self-employment schedule, which is the Schedule C. All right. Last schedule is the Schedule F. The Schedule F is for farm and fishery income. This is where you're going to depreciate those fruit trees and things like that. When I studied taxes, I actually had to learn all those rules. And I was like, oh my gosh, I mean, I really knew that I would probably never use them. I've only had maybe one or two clients with a Schedule F in my whole practice. Some cool things, though. I had this one woman whose taxes I did was doing like a passive solar greenhouse. That was pretty cool. But anyway, most of you listening probably don't have a Schedule F, but you know what? If you're running a rainbow trout farm or a salmon farm, cultivating oysters, raising cattle, whatever it is, then you will have a Schedule F, and that's where that goes. There are a lot of special rules for agriculture. So I would definitely say if you have a Schedule F, if your business is fishing or farming, it's worth it to find a tax preparer who is expert in that area, who has a lot of clients with farms or fisheries, because there are quite a number of special rules for agriculture that somebody like me who does like one farm return per 10 years is not going to be as brushed up on. Okay, so that's it. Those are the schedules. I just wanted to teach you that piece of tax education so that you have one of the basic building blocks, so that you know that not all income is treated the same, and what the purpose is of those schedules on your 1040 tax form. I hope that has been super, super helpful for you. Don't forget that if you want to get the deep dive on those deductions that go on your Schedule C for your self-employment income, you can download my free guide it's just a free visual guide to your tax deductions in your creative business at sunlighttax.com/deductions guide. And yeah, I hope you enjoyed that. Just print that out, stick it wherever you do your bookkeeping, and just keep it as a reference tool. You don't really have to look at it every day, but it's there when you need to know how to do your mileage or your home office. All right. Thank you all so much for listening. I will see you on the next one. Bye.